Evening, everyone. Welcome to Officer 24/7. My name is Nihar Kavalia Bhatnagar, and I am with you with the area of AFM. I hope I'm clearly audible as well as visible. Okay. Uh, if the session has been helpful to you, if the series entirely has been helpful, please go ahead and share the session along with this. Like it as well. And if you haven't subscribed to our channel yet, then please do the same as early as possible. Okay. Now, as I told you, the next series has begun. That means we have started with our module B. है ना? No, actually, we were done with the module B even. We have started with the module C. The module C, we have now moved towards the one of the most important chapters, that is ratio analysis. A chapter which is always asked in the examination. That too, not for some smaller amount of numbers. Ki the marks are little less that you can look forward to it, you can miss it out. No, you just can't. This particular chapter is super important due to its weightage in terms of case studies as well as the individual MCQs as well. Done? So let's begin with acha. I hope now it is visible everyone. Super important plus case studies plus important MCQs. मतलब I expect at least 5 to 6 marks for your examination would be from here itself. Done? Okay, then let's begin and start with our topic, ratio analysis. This is one of my favorites. The reason is ratios is overall divided into uh, the following parts. That is number one, liquidity ratios. Liquidity ratios means those ratios which are related to the area of liquidity. Second is solvency. Liquidity, solvency. Third is profitability and market test. Then is turnover ratios. And there are some miscellaneous ratios as well. So you will find all these specific bases on which we define our ratios. So on this basis, you will be able to find out what we do about the entire area of ratios. Matlab ratios is basically finding a numerical relationship between two or more items. And while finding those numerical relationships, what are we doing? The numeric relationship is defined and understood regarding the ups and downs. Maybe it has gone up in the last few years, maybe it has gone down, or if I say they have some ideal ratios as well, ki nahi, this ratio should be of this particular amount only. That's also something that you will find in ratios. So that's the basic crux, a little in-depth information regarding ratios. Okay, now here comes the first question, everyone. Today I have covered good number of questions and many of them are taken directly from the IIBF book itself. Matlab, as it is, the questions which are given in the book, I'm starting with those ratios, those questions, so that you understand what kind of questions are there in the book itself. The basic purpose of the series is to let you know what kind of questions are asked in the examination. So I am covering the entire book, strictly covering the entire area, whatever has been there in the examination based upon the previous year questions plus the IIBF book material, so that you don't have a problem in terms of understanding what kind of questions are normally asked in the exam. Okay, everyone, here comes the first question. Accounting ratios help in interfirm comparison, intra-firm comparison, comparison with industry norms, or all of the above. Actually, accounting ratios is one of the tools of financial statement analysis. It's a tool for financial statement analysis. Interfirm, intra, comparison, all. The answer is all of the above. Okay? The answer is all of the above. Now, second point, debt service coverage ratio. I think this is somehow they love this ratio. Why do I say this? Because this particular ratio was asked in promotion exams. This particular ratio was asked in our regular exams as well, in our examination of JIIB as well. So I think I have seen this particular ratio having its importance like anything. And this is basically a ratio which is very judgmental. Why do I say this? Because when we talk about debt service ratio, it's gonna ask the person, Hanji, do you have the capacity from your profit that you can pay off your debts as well as your interest? If you can, then only I'll say ki nahi, you should be taking loans. This particular ratio talks about the area of ability of someone to repay the loan or not. So based upon this, what would be the answer, everyone? Judging the margin of safety available before there's a default in repaying the loan, judging whether the firm has borrowing disproportionate to its net worth, judging the capacity of the firm to service the interest on debt, or all of the above. It's not all of the above, because margin of safety and the capacity of the firm to service is just not something which they choose. In this case, there's only one point, that is B. That is judging whether the firm has borrowing disproportionate to its net worth. Okay? The answer is A. नहीं, judging whether the company has, नहीं, the answer has to be A itself. Margin of safety regarding default and repayment. नहीं, it is related to repayment of loan only. So the answer is A only. B talks about disproportionate borrowing. It doesn't talk about disproportionate borrowing. It asks you that what is the profit you have, and in context with your principal plus interest. Any kind of principal repayments that you have to make, or any kind of interest repayments, that is why it is called debt service. So you have, if before the default of repayment of the loan, what is the amount that you normally have in your pocket? Which one of the following is true, everyone? Both earning per share and PE ratio vary with stock market price. While calculating DE ratio, fixed deposits from shareholders are taken part of debt. While calculating quick ratio, current liabilities are not taken into account. This is not true. Debtors turnover ratio is higher if the company sells more goods on credit basis than on cash basis. Earning per share is related to the area of earnings of the organization, and PE ratio is based upon the market price of the particular organization. MPS upon EPS is the PE ratio. So I believe the first one is definitely not something that we can choose. Okay? So this is also not true. The debt equity ratio, I think this is correct. Why? Because debt equity, in terms of debt, what will we do? Debt is basically the long term loans that we take. Those are called long term debts. The long term debts are a part of debt in this era. So in this case, the correct answer is B. While calculating debt equity ratio, fixed deposits from the shareholders are taken as a part of debt. Which one of the following is true? Higher debt equity ratio increases the profit margin of the company. Debt equity ratio is an indicator of solvency. A high current ratio is always an indicator of efficient management, or depreciation is not an expense, should be excluded from while calculating profitability ratios. Okay. When we talk about debt equity ratio, debt equity ratio will be higher if we get more debt. It is related to the area of solvency ratios. Acha, there is one more point. I'd written solvency ratios already. Yes, I didn't miss it out. I was thinking I missed out the solvency, but we did it. Acha. Now the answer in this case, it is an indicator of solvency ratios. वैसे तो it is related to the area of solvency, but a high current ratio is always an indicator. A high current ratio is never an indicator of efficient management. High current ratio simply means that sometimes you have kept too much of liquidity in terms of your organization, which is definitely not correct. The answer is B only. That the debt equity ratio is an indicator of solvency of a company. It's B. Given? Which one of the following statements is correct about fixed assets ratio, everyone? It is ratio of fixed assets and net worth. It is a ratio of fixed assets and long-term funds. It is a ratio of less than 1 indicates short-term resources have been diverted for creation of assets, or none of the above. Which one of the following is correct about fixed ratio? Fixed asset ratio. Fixed asset ratio talks about the organization funds which are involved exclusively in the area of the assets. So this is basically the assets that you have built with your long-term funds. The answer is B, everyone. It is the ratio of fixed assets and long-term funds. Done. Here comes the next question, everyone. This question relates to the area of net profit can be greater than operating profit when the net profit can be greater than operating profit. Actually, operating profit and net profit has two differences. It has only one major difference. Operating profit talks about only and only that part of the profit which the organization is making because they are working. They are working, they are operating their business. So operating profit is the money exclusively generated from the business, while net profit is the general funds that you are generating. Then what would be the answer? Cost of revenue from operations is more than operating expenses. Operating expenses are more than non-operating. Non-operating expenses are more than non-operating income, and non-operating expenses are less than this. Okay, when we talk about the operating profit is more, that can be more because the non-operating expenses, the ones which are related to the businesses which are not because you are operating in the business. That means it is not related to the business. You might have got some money in the business and you would have put it in the FD. Now from an FD you will receive a good interest. What is the expense? There is no expense in it. So in this case, what will happen? More of non-operating income will be added and non-operating expenses almost nil. है ना? So in this case, the correct answer would be where your non-operating expenses are more than the non-operating incomes. Answer is D, everyone. Then here comes the next question. The question says opening inventory of a firm is 80,000, cost of revenue from operations is 6 lakh, ITR is 5 times. Its closing inventory it will be 1 lakh 60, 1 lakh 20, 80 and 2 lakh. Opening inventory is given, cost of goods, cost of revenue from operations is also given, but they haven't given that part. Okay, let's try this question. Your ITR is equal to COGS upon average stock. Your COGS is given, which is of 6 lakhs. Your ITR is given, which is 5. But your average stock, for the time being, I'm taking it as I don't know about. So then you take average stock on the above side. Then it will come out to be average stock is equal to 6 lakhs divided by 5. So that would be 1,20,000. Now this is the average stock. Average means first year plus second year divided by 2. You know? So this is basically 1,20,000 is the average, which is opening stock plus the closing stock divided by 2. You know? That is how we find the average. So in this case, our opening stock was of no issue. The value is of 80,000, everyone, plus nil. Actually not nil, we don't know about it, so I'm putting it as the number x. And when we talk about The value of this question, it is 80,000 plus closing stock divided by 2. Now from here, we will calculate the exact answer. This will turn out to be 2,40,000 minus 80,000 is equal to closing stock. So the closing stock comes out to be amount of 1,60,000. Done everyone? Just look at the question. I hope it is helpful for you. Just give a quick look to it. You will be able to understand the concept. And let me know if you're all done with it. Done everyone? See, in this case, first of all, I had to apply ITR, then I had to apply average stock formula, and then we calculated the entire situation. Then we calculated the entire answer, right? Done everyone? Let's move on towards the next question. This was 1,60,000. Acha, ROI is calculated under liquidity, solvency, profitability, or activity. Activity is also called activity turnover ratios, everyone. We have talked about all these ratios already. Return on investment means whatever money I have invested in the business, in how much, what is the amount of return that I'm getting from that amount that I've invested. What would be the answer, everyone? Liquidity, solvency, profitability, or activity? The answer in this case, ROI. ROI is based upon profitability, everyone. ROI is basically your profit divided by the capital invested multiplied by 100. So the percentage which you get is called profitability ratios, because you're talking about the returns that the organization can make from their business. Done na? So profitability ratios are those ratios which are related to the profit of the organization. How much profit they are making after investing good amount of money in the business. Next question. Assertion and reasoning based, everyone. Liquidity ratios are used to assess the short-term financial obligations of the firm. Current ratios and asset test ratios are two liquidity ratios which measure the firm's applicability to meet its current obligations in time. In the context of the above two statements, which of the following is correct codes? Both are correct, but R is not the correct reason. Both A and R are correct, but R is not the correct reason. Then we have only reasoning is correct, or both are incorrect. Think about it, everyone. What would be the answer, everyone? Liquidity ratios. Liquidity ratio is just to find out whether the organization can pay off the loans or not. On a shorter basis, will they be able to do it? Then when we talk about current ratio and then the asset test ratio, these are both liquidity ratios which talks about in how much whatever money we have in terms of the payments which they are making, right? Asset test ratio or current ratio talks about the current assets which you are holding for less than 1 year are covered under this. Done everyone? Everybody, no idea? When we talk about liquidity ratios, it is related to the short-term funds only, and current and asset ratio is also related to the area of the short term. All these ratios are covered under liquidity, so they technically both are correct. The reasoning as well as assertion, both are absolutely correct. There is no mistake in it at all. Everyone, current ratio. Current ratio is liquidity ratio, liquid assets upon current assets, fixed assets upon current assets upon current liabilities, or liquid assets are divided by current liabilities. Current ratio is current assets upon current liabilities. So the correct answer in this case is C. That is current assets divided by current liabilities. Acha, everyone, if the GP ratio is 20%, goods for 50,000 sold to employee at the cost which will decrease the ratio. There will be no change in gross profit ratio because both the cost of revenue and revenue from operations will be increased by the same amount. You know? What will be the answer, everyone? Is it both are correct? Both are incorrect? Then everyone, what would be the answer? GP ratio based upon production. NP ratio based upon the sales that you are making out of that production. What would be the answer? Go ahead. GP ratio is basically the ratio which is strictly related to the area of a trading account, while NP ratio is something that gets into the answer in this case is actually both are the in terms of this A is correct and the reasoning is not correct. The reasoning is definitely correct because uh, there's a there's a growth which is somehow lopsided in our country, where you will find that in some areas there is an access to all these things, but when we talk about the other areas there can be scarcity as well, है ना? Done, everyone? Everyone, A is correct but R is incorrect. Done. Hello everyone, welcome to Officer 24/7. My name is Niharika Valia Bhatnagar and I'm with you with the area of AFM. Acha, as promised, I had promised you yesterday only that I'll be taking up ratio analysis, at least two classes. So, keeping up the promise, I'll be further discussing the topic of ratio analysis today itself as well. From tomorrow onwards, I'll change the particular topic further. So, everyone, we did the various kinds of ratios yesterday. There are 4 to 5 kinds of ratios. Do you remember all of them? Okay, let's have a quick recap. The first ratio is called liquidity ratios. The ratios which are related to the area of uh, the working, in which we are talking about liquidity is about the money that we are giving to the people now, or we are receiving within a year. That is liquidity. Second is solvency, whether in the long term the organization is solvent or not. Liquidity, solvency. Third is liquidity, solvency. Then is market test. Then is profitability. 1, 2, 3, 4. Done. Fifth is turnover. And sixth is miscellaneous. These were the 6 types of ratios. Uh, One of the most important ones is solvency, turnover, liquidity, and a few of miscellaneous as well. They are normally asked a lot. Market test is not something I've seen a lot, and not all the ratios are very important for you. Overall, there are 24, 25 formulas for ratios. So, yes, there are a lot of things to work upon in terms of ratios. Acha everyone, if you like these sessions, then please go ahead and share it among your peers, and at the same time like it as well. And if you haven't subscribed to our channel, then do the same as early as possible. One more thing, my new AFM batch has just started. It started yesterday itself. Matlab today is the first paid class. So if you are there, then it is starting it is at 7 p.m. Many of you won't be there now. So what you can do is, since we are having this class at 7:30 today, so that means what you can do is you can watch it from 7 p.m. to 8 p.m. And this particular video is also available on YouTube as well. So after the completion of the class, you can review it. This batch is at 7 p.m. to 8 p.m. every evening. So what you can do is you can join this particular batch and work upon your AFM properly. As you already know, 35 chapters overall, 35 units are there on almost 628 to 633, total 633 pages are there in the book. So if you are looking forward to enroll yourself in my AFM batch, then please do the needful as early as possible, because any kind of delay would mean that you will have to go through the basic topics on your own or through the recordings. Right now I'm starting with the live batch, so why don't you go through the live batch? The live batch is way better, na? So that's it. So make sure that you are enrolling yourself as early as possible. Now let's move on and start from where we were talking about. Done everyone? Chaliye, then let's begin. The two basic measures of liquidity ratios are. What are the two basic measures of liquidity ratios? Liquidity means how liquid we are in terms of the work. Liquidity is basically related to the area of how much, how frequently can you pay. Matlab, or you can receive. Can you pay or receive within 15 within one particular year, less than 1 year or one operating cycle? If you receive your money, then your work is sorted. If you do not receive the money, then there is a problem. Okay, right? So for example, I won't wait for a good amount of time when I have to receive money from the debtors, isn't it? If I'm supposed to receive money from the debtors, then it should be within that one particular year itself. Now, if the debtors are paying by more than 1 year, it is such a big problem for you and me. Why? Because if these people are going to take so much of time, then what's the fun? For a business, it is actually a troublesome situation, isn't it? That it will take so much time to receive the money, so liquidity gets affected, the cash in hand which they will be having. Then so liquidity ratios are these ratios. So among these, what is the ratio that they're talking about? In this area, how do we specify? Liquidity ratios are basically inventory and current. No, inventory is a turnover ratio. Inventory turnover ratio means that is related to the sales that you are making in the business. Then we have current ratio and quick ratio. Current ratio and quick ratio both are liquidity ratios, so I think this would be the answer. Next is gross profit and operating profit ratio. Operating profit and gross profit are profitability ratios, and current and average collection period. Average collection period is also a part of turnover ratios. Only current ratio is the one. So in this case, the correct answer is actually B, everyone, as B is current ratio and quick ratio. So the correct answer is B. The answer is B. Done. So that is current ratio and quick ratio. The excess of current ratio is also treated as a sign of managerial inefficiency, efficiency, inefficiency, or none of the above. Excess of current ratio matlab we are having too much money in our cash form. But the problem is that if you have too much money in your cash form, why are you having so much of money in your cash form? You are not getting any returns out of it. If you would have given this money to someone else, maybe you would have received a good amount of money, but you didn't. What are you doing with this money? You are keeping it in your business itself. And slowly, slowly, this loss is basically borne by you, and this will, what will happen? It will scrap off all the savings of that business. Over the period of time, when he keeps on hiding those things, things can become manifold. So when we talk about the area of debts and equities, now it is very, very important that whatever cash we already have, uh, we do not devalue that part. We should spend money on all these things very, very carefully so that the returns are definitely something that we can look upon. You know, so in this case, it is talking about the inefficiency. You could have used specific money for the business, but where they are using it in order to look forward towards the inefficient areas. This money is not used in the business at all. This is basically something which is just idle. It is there in the cash form and you are not making any money out of it, which is definitely not useful. So the answer is inefficiency, everyone. Done. Now comes the next point, inventory turnover ratio, or inventory ratio is the relationship of. It's an important turnover ratio. Everybody? Inventory ratios is basically the ratio of your cost of goods sold upon your average stock. This is basically defined as the opening and closing of this part. है ना? Technically, inventory turnover ratio is that specific ratio in which we would be uh, we would be looking forward towards inventories in such a way that the organization head would be looking forward towards the person who has helped, and then they would be asking the address and everything. When we talk about the area of inventory turnover ratio, now inventory turnover ratio talks about whatever finished goods that you are preparing, starting from raw material to finished good. How did we go through it? The cost of goods sold and cost of average inventory, cost of goods purchased and cost of average inventory, cost of goods sold and average cost of average inventory and shield, and the cost of goods purchased and cost of average inventory. Now this is, as I told you, it is cogs upon average stock. That means we would like to know how much of our stock is left by the end of the day, and opening and closing stock is basically taken as a mean there, and then we compare it with the goods that we have purchased and we have sold. That is cost of goods sold divided by cost of average inventory. Acha everyone, here comes a numerical question. The numerical question says that the cost of liquid assets are 5 lakh rupees and its current liabilities are of 3 lakh rupees. Thereafter, it paid rupees 1 lakh to the trade payable. Quick ratio will be what? Everybody, what would be the value of quick ratio? Okay, quick ratio is also known as acid test ratio. When we talk about quick ratio or asset test ratio, this is quick assets upon current liabilities. Quick assets are those assets which are simply something which can be converted into liquidity within no time. It includes all the current assets except two things. First is your inventory and your prepaid expenses. So this particular area does not include, because inventory takes a lot of time. It is not sold within a day, so there is no point of fighting over it. And when we talk about the prepaid expenses, same thing goes with the prepaid expense. If I paid for my land, if I paid for a particular, acha, I paid for my phone. I have a prepaid. I have a prepaid SIM. The moment I get a prepaid SIM, what will happen? The value of the prepaid sim would be noted. है ना? Prepaid sim would be, maybe I got a particular plan for 600 rupees and that's for 3 months. So for 3 months I've paid in advance. Can I go to Reliance and can I go to Jio and say that, sir, can you give me the money for 2 months back? I just wanted to pay for 1 month and the rest I was thinking to close down. Will they do anything? No, they will not give you the money back. So prepaid expenses once paid, that you won't get that money back. So technically you will have quick assets divided by current liabilities. So can we do this in this area? We have liquid assets as rupees 5 lakh. Then we have 3 lakh. And thereafter it paid 1 lakh to the trade payables. That means if we have paid, so 1 lakh from the cash is gone. Then when we talk about the current liabilities, the creditors are also lessened. In this area, it turns out to be 4 lakh divided by 2 lakh. It turns out to be 2:1. है ना? Can you see the 3 lakh? अच्छा, see, from the quick assets, you are paying the cash. And this is what your trade payables are. The trade payables are paid off. है ना? Technically, the value will turn out to be 2:1. It is actually getting better. Always remember, if you have a lot of liquid assets, that means you are not being wise. Why are you keeping so much of money? Keeping such a big amount of money is not sensible at all, right? This much amount of money when kept in the business, in the flow of cash, there is no return of it. The money which is kept in a which is kept basically kept in boxes, and it is which is kept in lockers, will not multiply. The money which is rotating in the market will multiply, right? The dash may indicate that the firm is experiencing stockouts and lost sales. But the company's average payment period, inventory turnover ratio, average collection period, or quick ratio. Which particular ratio among the following states that, everyone? The ratio which talks about the area of the stockouts as well as the lost sales. Average payment talks about the money that you are paying to the creditors. Average collection is the money that you receive from the debtors. So this is related to the creditors. This is related to the debtors. So in this case, the correct answer is inventory turnover ratio. Under inventory turnover ratio, that is the movement of inventory. So if we have a lot of movement in inventory and it is being stock out and all, then it means that our inventory is being sold at a very high pace, and we are falling short in terms of predicting the future of our product. Stockouts will create a negative point for the organization, that whenever you go to the organization, there things are always stock out, which is not good for the organization. At one point of time, it can show it to the people that maybe the organization is so good that it gets stock out, but at the same time they can see that the organization is fake, because there should not be a stock out, and but they are still showing. This can be both the ways for the organization. Again, when you are trying any tactic in terms of the finances, now sometimes it can go positive and sometimes it can go negative, but there is no point where it would be the same. Dash are specially interested, I'm sorry, in the average payment period, since it provides them with the sense of bill paying patterns of the firm: customer, stockholder, lenders, and suppliers, and last is borrowers and buyers. When we are talking about this, the average payment period, everyone, the average payment period, since it provides them the sense of bill paying pattern. Acha, everyone, when we are talking about average payment period is the amount by which the payment is made to the billing patterns, na? Yes, the amount which is paid to the creditors, to the lenders overall. So basically, this is related to that area. But when we talk about the average payment period in terms of uh, with a sense of bill paying, the bills are normally paid to the lenders and suppliers only, creditors only, na? We receive money from the debtors and we pay money to the creditors. Simple reason, payment is to be received from the debtor, and the creditor is always on the credit side. Done. Next question. Which ratio is not a part of solvency ratio, everyone? Current debt to equity, total asset to debt ratio, or proprietary ratio? What would be the answer, everyone? Which is not a part of solvency ratio? Solvency ratio talks about the money which is paid, which can be easily paid. We have money to pay it off. The answer would be current ratio. Current ratio is liquidity ratio. The answer is liquidity ratio. This ratio is liquidity. Rest everything qualifies for solvency. So in this case, solvency talks about if you had been asked to give me a certain amount of money, can you pay me that specific amount of money or not? If you are supposed to pay 10 lakh and you are able to pay me 10 lakh within 3 months as per your promise, then what will happen? You would be respected. And if you do not do that, then you would be then the organization will have to specify na. Solvency is all about whether you can pay off your loans in a proper way or not. Then you have the total assets, total liabilities, current liabilities, and total assets to debt. They have asked your total assets to debt ratio. What would be the answer of total assets, everyone? What would be the answer, everyone? Total assets is 7,70,000. What would be the answer? What would be the answer, everyone? Total assets divided by debt na? Debt is only the total debt or long-term debt? It would be total long-term debt only. The short terms aren't its responsibility. What would be the answer? In this case, the total liabilities are given. The total liabilities are of 2,60,000, everyone. Let's look at this. 2,60,000 is the total liability. From the total, you remove the short term. Short term is of 40,000. So what are you left with? 2,20,000, which is pure long term. है ना? Because the short term are removed, this is your pure long term. And now divide the entire salary there, that is the entire total borrowers and anything else that we're looking forward to, then it would be 35, this amount of 7 lakh 70 would be taken now. Let's see. 7 lakh 70 is the total assets and our debt is only the long term. है ना? और no short term involved. This is 2,20,000. So this has to be 11 sevens are 77 and 11 twos are 22. That made us in this area. It turns out to be 3.5 is to 1. Why, everyone? It is 7 lakh. It is 7 lakh 70,000 divided by 2 lakh 20,000. So based upon this, the answer is 3 is to 3.5 is to 1. What would be the answer? The answer is 3.5 is to 1. Everybody got the idea? Whenever we are calculating these na, always remember total. This was total asset to debt ratio. Total asset to debt ratio. You don't have to learn the ratio, the fun part, because the ratio is already specified. Let me show you again, everyone. In this case, the debt includes both long term plus short term. The total liabilities are 2,60,000. out of which the short term are 40,000. So can we calculate the long term, everyone? The long term will be 2,60,000 minus 40,000 is equal to 2,20,000. Once you have got this 2,20,000, then utilize this 7,70,000 divided by 2,20,000, giving you an amount of 7,70,000. That is 7,70,000 divided by 2,20,000, giving you 3.5:1. Let's go for another question. The following groups of ratios primarily measure risk. Among the following, which measures the risk, everyone? Liquidity, profitability, activity, liquidity, activity, common stock, liquidity, activity, debt, and liquidity, debt, and profitability. Measures risk. It is debt is very risky. Profitability, if we are not making good profit, then there's a very good amount of pressure on our heads. And then we have activity. Activity talks about how active we are in terms of our working. Good evening. Today, what are we going to do? Another day of the same series. Everyone, first of all, please go ahead and like this particular session. It is super important that I get a source of motivation, and you are the source of motivation. By sharing the session, by liking the session, definitely you make me feel that yes, bring up something more questions, more usable questions, more relevant questions for the examination from the book itself, so that you can prepare properly. So I would still give the credit to continue the series with you only, and I would love to get the appreciation, recognition from your side with the same level of intensity, I would say. Acha everyone, now the first point. What are we going to do today? We were discussing module B. I'm going to start with another topic which is called financial and operating leverages. The most important part about the financial and operating leverages is this topic is always asked in the exam. When I say financial and operating leverage, financial and operating leverage is always asked in the examination and till date. And the case study was asked in the November examination, which was roughly 5 to 6 marks because there was a case study. There were 3 questions with it. So technically 3 to 4 questions were attached with it. We had to calculate everything for that particular question. That means you had to calculate earning per share, EBIT, and then the different kinds of leverages. Leverages are basically of 3 types: financial, operating, and the last one is combined, which is the mixture of both the kind of leverages, everyone. So that's leverages for you. Now, the point is, what do you mean by operating leverage? Operating leverage says कि I wish I can increase my revenue from my current earnings only. मतलब whatever way I am working currently na, I wish I could increase my business with the current earnings. I'm not saying my previous earnings or something else. Nah. With my current earnings, I would love to increase my with my current status, with my current scale of operations, I would love to have a greater sense of earning. While financial says, nahi, I think we have earned good enough with our current level. I wish I can earn more. And how can I earn more, everyone? Maybe I can scale up my operations. Maybe I can invest further in terms of the I can invest in terms of the assets. Maybe I can invest in terms of the plant. I can increase the output that is being produced. If I'll produce more, maybe I'll sell more as well. You know? So that is how we specify the operating and financial leverage. Then they say combined. Matlab, you do have to do nothing. You just have to write the formula for financial leverage. Then you have to multiply it by operating leverage. What you're left with is called combined leverage. That's one of the basic definition of leverages. The entire definition of leverages can be defined according to this. Now the point is, what are we going to do today? Obviously, we will be starting with this particular scenario. We'll be studying it in detail. What exactly is covered in this area, है ना? So let's understand it from the point of view of accounting, from the point of view of entire ABFM. Okay, here comes the first question, everyone. Number one, what is the measure of the return on investments? We are always looking forward to what? Um, Return for equity shareholders in a business. Everyone, what are they talking about? Debt ratio, earning per share, financial leverage, as well as total assets. How do we define it, everyone? Okay, let's look at this. Debt ratio is the proportion of debt in terms of equity. Then we have the earning per share. Then we have financial leverage. Financial leverage is related to the area of the increase in the scale of operations and total assets. That's not the point there, है ना? So the correct answer is earning per share. Why earning per share, everyone? Earning per share is your net operating profits. Net profit divided by the definition of earning per share is net profits after tax and preference dividend. मतलब we have paid both of them divided by just a moment, divided by number of equity shareholders. मतलब it's like there is a cake and this cake has to be divided among certain number of people. So we have to find it, है ना? We have to divide it by the number of shareholders. This is the point that we were looking at. Now comes, this is the formula. Now everyone, if I have a bigger share of cake, is it good or bad? If I have a bigger cake share, then definitely it's good. Then the problem would be what? When the share of the cake is smaller, then it's something that's gonna hurt me for sure. Isn't it, everyone? That is how we define this specific area itself. Okay, so this is how earning per share is defined. Higher the amount, higher the better. Overall, if I have better amount, it is always something which is more attractive for the businessman. If he's putting money into the business and he gets more money back, then he's always happy. कि अच्छा ठीक है, if I'm investing something, I'm getting something out of it as well. What constraints is faced when the increasing borrowing without increasing equity in the financial leverage? Oh, think about it, everyone. The business is increasing its borrowing. Matlab, what are they doing? They are increasing their debt. अच्छा, debt and equity have a very strong bond, पता है? A higher interest rate on the borrowing, lower return on equity, decreased cushion to absorb adverse events, or reduced cost of borrowing. First of all, there is no reduction in the cost of borrowing for sure, because ultimately we are paying, है ना? But what if my debt is increasing, my liability is increasing, the amount that I have to pay, my burden is increasing. All these things are happening. So when we talk about what constraint is faced when increasing borrowings without increasing equity in financial leverage, when we talk about this, what are we doing? We are increasing our debt. In this case, when we increase our debt, the interest rates are high and the principal repayments are also high. That means if we pay both of these, our profit will decline. When our profit declines, the portion for equity is going to decline further. Matlab equity is gonna be hurt badly. So ultimately, if equity's money is being used and they are not able to put much money into the savings, what's happening in the near future when there would be a problem? There is nobody to provide us a cushion. technically the decreased cushion to absorb the adverse events, because equity will not be able to save enough for the future of the organizations, and this is not good for the organization. So that's an important area to understand. If you increase your debt a lot, then it is very much risky for the organization, because a lot of debt means you have a lot of risk involved, financial risk. The ability to take more loans is also affected badly, because you already have loans. And basically, when you have too much of loans, how will you justify it? How will you answer to the government and towards the income tax department that you want more loans? You won't be able to justify yourself, and this is definitely not good. That's why whenever your financial risk increases, even equity people try to move away. They will try to sell their shares to someone else. Ki, "ठीक है, the company is dying. I don't think I'll get even a single penny back. Sell away the shares of this organization and get rid of it." So they're absolutely clear about the fact, because always you will put money into an organization which seems to be safe. Obviously, not everything is going to be safe. That's why all those scams happen. But they would always want to work with an organization which seems to be safe. है ना? चलिए. Now comes the next point. Um, how is financial leverage described in context of the impact of equity? A single-edged sword, a modern strategy, a double-edged sword, or risk-free approach? Okay, financial leverage. Basically, what we did is financial leverage can be defined in a very simple manner. Basically, the organization felt, "Arey, we need money." They said, "Okay, we need money. What next?" Then, acha everyone, if I need money and taking too much of equity will cost me voting powers. It will cost me voting powers, na? So, let's write it down that we are talking about voting powers. You are sharing your voting powers with someone, you don't want to do that, we are all sorted with it. That's why what you did was you took a loan. As soon as you took a loan, what is happening? Your debt is increasing. Fine, it is tax deductible, so interest is basically something which is charge and expense. Now the point is, this loan has helped you and the project has made good profit. The project has made good profit, has made profit. Everyone, once they have made profit, what next, everyone? Once they have made this huge amount of profit, what will they do? If they have made a good profit, the next thing that they have to do is, if you have made good profit, then equity shareholder is standing in front of you. Ki Hanji, where is my money? Excuse me, why are you not giving me my share? So technically, because of debt, your reward is increasing. Reward is profit or dividend that we are receiving now. So equity shareholder is like, wow, the company is growing and I'm not getting my share. So technically, you took a loan so that you don't have to bear the problems of equity, but ultimately you will be still answerable to equity that the company has started making good money. Where is its share? It is gonna cry about that fact. So it's a double-edged sword, a sword which gonna hurt you badly. Even if you are growing through equity, then what will happen? Equity shareholders will wait कि bonus shares कब आ रहे हैं? When are we getting the right shares, bonus shares? The directors of the company would be waiting for swap shares, swaptions, and नहीं, they would be looking forward to ESOPs. है ना? The company is going good, so equity shareholders are gonna be happy and they would be demanding. While when we talk about the debts, the debt is never gonna ask you something. You take a loan, you pay it back, they will never ask for more money. Until unless they're definitely involved in some kind of fraud, of course. Otherwise, if I took a loan for 10 lakh for 10% rate of interest, there is no other point of question for me. Isn't it? The companies are gonna come after me. So we are all sorted about this part. Done, everyone? So when we talk about this area, it's a double-edged sword. You earn more, you have to pay more. You earn less, then you have to pay less, but then your share capital will also be less. Chaliye. Then comes the next part is double-edged sword done. Then what is the formula for degree of financial leverage? Acha everyone, financial leverage is gonna help us to grow in the long term. Always remember, this is not something which helps us in the short term. This is something which helps in the long term. If it is gonna help us in the long term, what's the formula for it? It is EPS upon EBIT, or EBT upon EBIT, or EPS upon EBT, or EPS EBT upon EPS. EBT or EBIT is what, everyone? EBIT. This is earnings before interest and tax, while EBT, earnings before tax. And earning per share we have just calculated. Let me tell you what to do. You take up your selling price minus your variable cost. You will get your contribution. Then remove your fixed cost. Then what you are left with is profit, which is also called earnings before interest and tax. First of all, you pay interest. Then what you're left with, earning before tax. Then you pay tax. Then you're left with earnings after tax. This is the entire process that you have to follow in this area. And how do we calculate it, everyone? EBIT, EBT. The formula for financial leverage is basically EBIT divided by EBT. Acha, in this case it is written wrong. Let me just, it's not given in any of the options, so let me just correct it a bit. It is actually EBIT upon EBT. ठीक है? The answer is B. That is, we're gonna find out how much this financial leverage is gonna cost us. Financial leverage means it's a burden because you have taken this particular risk now. Acha, okay. I think they made a mistake as well. That is the normal formula that I've shared. There is one more thing. This is the normal formula. When we talk about the change now, in terms of change, we have EPS divided by EBIT. In terms of the change. Change means we are talking about the change in EPS, that is EPS for the previous year, current year. Then what you do is divided by EPS of the previous year. This means EPS 2 minus 1, right? EPS of previous year, previous and current year, and you divided by EPS. So technically that is change in EPS divided by change in EBIT. EBIT means you are going to consider 2 specific years where you are going to basically, what are we going to do is we are going to question it. We are going to tell it out. We have to find it. So the answer is EPS and EBIT. I'm sorry. Where we have EBIT upon EPS. Done. Next is, why is degree of financial leverage important in calculating correlation between EPS and EBIT? Actually, it is very, very important actually. These are the only 2 terms which we talk about now. Earning per share is what? What is the piece of cake which is left for the equity shareholders when everybody else has eaten up? And this is the amount before you give even a single penny to the people from whom you have lent money, or from the people to whom you have given money. In any case, covering all those areas. Matlab, we are taking up the people who will get the ultimate amount and the money before paying even a single penny to anyone. What's the amount, right? What would be the answer? To estimate the value of the business or assets, to determine the risk, right attached, right mix of debt and equity. But just like if I make a cake, I need to know what's the perfect blend for cake in terms of baking soda, in terms of the multipurpose flour, in terms of the sugar. In terms of a business, we have to be very clear about what amount of debt we are going to take and how much money I'm going to put off my own. Because taking too much of debt is risky. Taking no debts is also a stupidity, because then what will happen? If there are no debts, you don't have a tax deductible expense for you there. Especially when by taking that loan while paying from the regular business, it would be helpful to reduce your profit. Less profit means less tax. Less tax means more money for the equity. To evaluate the risk of business, to establish the correlation between operating and interest expense. Um, EPS and EBIT. This is the degree of financial leverage which is used for in this case. So the correct answer for this question is actually, as you can see, this is interest and tax. None of them is related to the area of interest is finance based and taxation is by the end. So technically, I'm sorry, when we are trying to reach to EBIT to EPS, the company reaches out from EBIT to the ultimate amount. So technically, first of all, there is operating profit. This is before EBIT. Whatever we have is operating, because we have to run our business. And then we consider interest, and then we consider tax, and that's how we reach the ultimate end. The cake piece which is left for the equity shareholders. So the answer is D, to establish the correlation between operating profit and interest expense. Done, everyone? Now comes the next question. Next question is related to the area of, we are given sales. This is an important question. I would say you should definitely do it. It's an important question for your examination. First of all, your selling price is 24 lakhs. Your variable cost is 50%. That means it is 12 lakh. Left with 12 lakh. Then we have fixed cost of rupees 10 lakh. We are left with 2 lakh rupees. This is your earnings before interest and tax. They haven't talked about any kind of interest, did they? Yes, they talked about it. This is, they have borrowed 10 lakh at the rate of 10%. Matlab your interest is 10%. 1 lakh rupees goes into interest. The company earned 24 lakh. Think about it. They're left with almost nothing. 1 lakh rupees is their earnings before tax, and the tax is 50%. That means earning before tax, they are thinking we are getting 1 lakh minus taxes 50% of it. You're left with barely 50,000. This particular point is definitely something which is very alarming for the organization, because they're left with almost nothing. You know? So this is EBIT upon EBT. The formula is, I've calculated everything for you. The basic reason is that you should understand how to go through it step by step. So we have EBIT divided by EBT. That is 2 lakh divided by 1 lakh. This is EBIT upon EBT. So in this case, the correct answer is 2. Okay, this is actually a book question. The reason behind doing this question with you is this only, so that when you do all these questions, you get more clear about how to deal with such kind of questions. Hello everyone, welcome to Officer 24/7. My name is Niharika Wale Bhatnagar, and I am with you with the area of accounting and financial management for bankers. First of all, happy Lodi, happy Bihu, and happy Pongal, everyone. On the eve of these multiple festivities going on, we have started with our sale. That means our official sale is on, where you can get double validity on all our Mahapacks, as well as 80% discount on all our courses. So if you're planning to purchase any of these things, then it's high time you should do it right away, because the sale is there for a very limited period of time. So if you're planning to do this, then please go ahead and check it out on our website or in our app for further details. Along with this, if you find my sessions useful, if these sessions had been helping you out in terms of the studies and all, then what you can do is please go ahead and like the session and share it among your peers, because when you are there to motivate me in terms of my teaching and the work that I'm doing right now, that really brings up another level of spirit that keeps us going in this particular field of YouTube and working and teaching. So just a little step of yours is definitely very valuable. Okay, now what are we doing till now? Module C. We have reached the module C, another chapter, that is calculation of YTM. Another very, very important chapter. I think from the last three classes, you would have been hearing this particular term from me a lot, and you would have been thinking ki almost every chapter, ma'am is saying ki this is very important, this is very important. What exactly is very important? Isn't it? Overall, I call the entire module C very important because module C is something which is normally asked in the examination a lot. This was earlier a part of module A of the previous syllabus. Once the new syllabus was introduced, this was a part of new syllabus. Okay, so that's a part of the new syllabus right now. So this is again a very important era. So I think if I have to tell you, ratios plus interest and annuities. वैसे तो ratios is something which always comes in the form of case studies. Then we have this chapter by TM. Then we have forex. Up to even derivatives is there. This is a new chapter which they have introduced. I believe these are one of the most important practical chapters for you, right? Forex and YTM. These are good in terms of the questions. The questions are quite tricky, as well as the content is definitely very interesting. Why? Because now there are practical based theory questions that can come from the area of YTM, at least that I feel. So today I'm going to give you an insight of all those kind of questions. In the upcoming class, I'll discuss the numerical portion of it, of course, so that you can get a view of what kind of questions exactly comes from the area of YTM. Acha, so this is the entire era of module C, which I personally feel is very, very important. And I'm sharing all those important questions as well. I think I'll start with a few more questions where I'll add up once we are done with the entire series now. I'll start discussing questions which have been asked in the previous year as well. All these questions that you are currently getting is directly taken from the IIBF book. I prepared those questions, I share it with you. So if you're planning to continue to stay with me, then what you can do is stay tuned. Once the entire sessions are over, then I'll add up the next point of it and then I'll continue it that way. Ki every single time that we are having a class, I'll keep on adding more and more set of questions for you, right? Okay, now here comes the first question, everyone. Acha, we have talked about debt and equity. Debt is what? Debt is the money that I take from others. That's something that we call as the loans taken from others. And equity is what? Equity is something which we call the uh, the owner's funds. है ना? This is the funds which the owner of the organization is putting. Now the point arises that which one of the following statements about bonds is not correct? Bonds is among the debt. Debt is what? Debt is actually a loan that has been taken, and this loan really affects our business badly. Now, the first point is bonds are debt instruments. Bonds are a part of net worth of an enterprise. A bond is issued for a specified period of time. A bond carries a specific rate of interest. It carries a specific rate of interest. These are again debt instruments. But do you know this be a part of net worth, everyone? Net worth is what? Net worth is, if I ask you what kind of money do you possess? So when we talk about the net worth of an enterprise, in this case, it's gonna be the area of debt is to equity. In this case, it is going to be the net worth is related to pure equity. It has nothing to do with debt. So in this case, bonds are a part of net worth of an enterprise. The duration of a bond is the holding period for which the interest rate risk disappears, the period remaining for the maturity, the period for which the bond has been issued, or the gap between the two interest payments. What do you mean by the term duration, everyone? Duration basically means any kind of period That is one particular thing. Now what they are talking about in this question, how do we define the term duration? Duration of a bond is what? It is related to the period for which the interest rate is there, duration of the bond is after which I would say that the period for which the interest rate risk disappears. The point is, in terms of duration of a bond, you will definitely receive interest during that period. Why? Because bond is basically the interest payment of a bond is compulsory payment. You cannot crib about the fact कि पता I had to pay, but now I don't pay today. Maybe I'll pay tomorrow. Maybe I'll pay after day after tomorrow. No, you cannot. The due dates for the bonds are already set, and if you don't pay in time, the lenders have the right to receive money from you. That's one of the strongest points about the bonds. Okay. Now comes the next point. In this era, the answer is the holding period for which the interest rate risk disappears completely. Then when the required rate of return, market interest rate, is equal to the coupon rate, the value of the bond is less than its par value, more than its par value, equal to its par value, decided by its unexpired period. Acha, this point is the rate of return required rate of return is equal to coupon rate. Coupon rate is basically known as interest rate. This is one of the terminologies of YTM. Interest rate is equal to coupon rate. When we talk about the coupon rate, when the required rate of return is equal to coupon rate. Required rate of return is what you want. If what you want is the same amount that you are getting in terms of interest, at this point of time, it would mean that it is equal to the par value. Why? Because what I wanted is what I'm exactly getting, right? The next point. Which one of the following statements is correct? Bonds can be issued only with call option. Bonds can be issued only with put option. Bonds can be issued with both call and put option. Bonds cannot be issued with put or call options. What do you mean by put and call options, everyone? Bonds which are puttable, callable, these are basically a situation where the company has when the company has the right to call people, come, we have money, we would like to pay you. That is call. Put option is where the investor has the right to come to the company and say that we want you to pay us before time. So that kind of thing is also available when the bonds are payable on demand. Anything that is payable on demand, there you have this option. In terms of bonds, you have both kind of options. You have callable as well as puttable bonds. So in this case, the bonds can be issued with both put and the call option. So in this case, the bonds can be issued with both put and the call option. Now, which one of the following statements is or are correct about zero coupon bonds? Acha, zero coupon means this is a bond which has no interest. Can I give someone 100 rupees as a loan and then I cannot ask for any interest rate back? Won't it be weird? It would be. So, zero coupon bonds pay no regular interest. Technically, they don't. That is why they are called zero coupon bonds. They are issued at a discount to par value. The bondholder receives a full principal amount on the redemption date, or all the above statements are correct. In actual, all of these are correct. The zero coupon bonds are basically issued at a deep discount. Matlab maybe it would be issued at 80 and they would be redeemed at 100. So technically this 20 rupees is basically your interest. Okay, this is what we call as interest. So technically all of the above statements are absolutely correct. What is the relationship between duration and the term to maturity? Duration is basically the time period for which the interest is received by you, and the time when you will receive the money is called maturity. So in this case, the question is saying that what is the relationship between the area of duration as well as the term of maturity? How do we look forward to this, everyone? In terms of this, Duration is always equal to the term of maturity. Duration is greater than the term of maturity. Duration is less than the term of maturity, or duration and term of the maturity are unrelated. Acha, when we talk about the duration and the term of maturity, in this case, one particular thing is there, that is duration is always less than the term of maturity. You will always have to make sure that your term period for which you are putting it, the duration is always less than it. The payment should be made before time, na? Or at least in time. This is the point. Duration is less than the term of maturity. Before the bond becomes mature, that particular portion is called duration, time period for which it is due. You know, how does the frequency of the coupon payments affect the duration of a bond? Increases the in coupon frequency, increase duration, decrease in coupon frequency, increase duration. Now these kind of questions I was telling you, this is a tricky part for the examination. Why? Because we do not anticipate they can give questions like this. In the upcoming class, I'll discuss the MCQs which are related to the numericals. You'll be like, these are easy, ma'am. But the point is, this kind of question are very difficult in the examination, and you should anticipate they are putting these kind of questions, because both in May as well as in November, I saw these kind of questions being asked in the exam. So you should be very clear about what kind of questions are coming up and how do we look forward to it, right? So, okay, when we talk about increase in coupon frequency, increase duration, decrease in coupon frequency, increase duration, then coupon frequency has no impact on duration. नहीं, ऐसा नहीं है. Coupon frequency is interest rate. The duration of this particular point. See, decrease in coupon frequency. If I am if the interest rate and everything else is paid with a little delay there, you know, decrease in coupon frequency. If the frequency is constantly decreased, this will increase the duration for that particular bond, right? So duration is directly proportional to coupon frequency. No, the answer is B. The decrease in the coupon frequency, that is the portion of interest rate, it will always increase the portion of duration. So can I say frequency and duration have an inverse relationship? Not a direct relationship, they have an inverse relationship. These kind of questions should be anticipated in the examination, because this is an eye-opener. For these questions, we should be very open and clear about it. You know, what is the relationship? These are out of the theorems of YTM, everyone. What is the relationship between duration and yield to maturity? Okay, duration is basically what? The time period for which that is due, and YTM is what? YTM is yield to maturity, whatever the yield, that is the ultimate income that you are getting. See, they are directly proportional, they're inversely proportional, or no interest rate between duration and YTM. Duration and YTM are always equal. In actual, your duration and YTM are inversely proportional. That means if your YTM is increasing, your duration will be decreasing. Vice versa, if you increase your duration, the YTM would be lesser. If you would have seen in terms of the long-term loans, the interest rate is less than that of the short-term ones, because in short term you're in dire need, while in terms of long term you are not. So technically, keeping these things in mind, they are inversely proportional, right? How is the market value different from face value or redemption value? Market value is always higher than the face value. Market value is same as redemption value. Market value may be different from face value or redemption value, or market value is always lower than the redemption value. We have something called market value. Market value is the value at which we can get it in the market. Face value is actually the value at which we purchase it. That is what at which we are issuing it. This is actually the book value. And redemption value is completely different, the value at which we are redeeming or making the payment to them. Technically, these can be extremely different, because whatever the value there in the market is based upon demand and supply of those things, right? So when we talk about the demand of the bond is increasing, then obviously the market value of it will go higher or it will go lower depending upon the demand of that particular bond or the economic situation of the country or the market. So technically, keeping all these things in mind, you'll be standing in a situation where market value may be different from the face value or the redemption value. Okay, what is the purpose of day count conventions in bond markets? To determine the coupon rate, to calculate the face value, or to establish the market value of the bond, or to calculate interest payments based upon the number of days. Everyone, when we talk about day count, it is basically to calculate the interest payment based upon number of days. Done, everyone? So in this case, it's going to be D. Okay, the next question is to calculate interest payments based upon the number of days. When we talk about the day count convention in the bond market, technically, if we talk about the payments, the interest in some cases, if it is redeeming before time, then you will be given proportionate interest rate. Now, so when you're given interest rate according to the number of days, that is day count. You consider each and every day. So that means if they say 12% per annum, then it would be 1% per month, and 1% per month, matlab 1% divided by 30 days, and then you calculate it per day as well. So you need to know if you're holding the bond for a certain period, then what would it be? The bonds are also transferable, so people can also transfer these bonds. So technically, the investments here are now very much reflexible. You know? So here comes a bond which is called bearer bond, backed by the government assets, non-negotiable, registered by the number to prevent counterfeiting, an official certificate issued without a named holder. Acha, what do you mean by bearer? Person is clearly not stated. That is what we call it as bearer bond. You know, so bearer bond is the one where no name is stated. It has nothing to do with the backup of the government assets. If there is an asset backed up, it is basically based upon the um, registered ones. In this case, we are talking about they have secured debenture, secured bonds are the ones which have been backed up. And then we have registered non-negotiable, and non-negotiable are the ones which are non-transferable. वैसे तो they are all transferable in terms of bonds. And we talk about registered by the number of to prevent counterfeiting. With the point is, bearer bonds are very overall now they are very prone to frauds and all, because there is no name written. The one who's holding it is the owner of it. So this is a little riskier bond, I would say. In this case, the answer is A. Sorry, D. An official certificate issued without the named holder. Acha, which option provides the issuer the right to repay the bond at the par or with the premium or on a specific call dates? Put option, callability, putability, callable option. They're talking about issuer the right to repay the bond. मतलब the company has the right to call the person कि ठीक है ना, you come and we will pay you. We have got good amount of money, we'll pay you in advance. So what will you do? In this case, the answer is callability. Bonds are callable as well as bonds are putable. Matlab in this case, if the investor had the right, in the opposite case, the sorry, in this case, the company had the right, and now investor also had the right. What is the result if a bond is referred to as putable or retractable? The bond has variable interest rate. The issuer can repay the bond at any time. The bond holder has the right to force the issuer to repay the bond before the maturity date, or the bond is backed by a mortgage security. No, when we talk about mortgage security, the secured ones, secured bonds. The bonds has variable rate of interest. Normally they don't. They have a specific interest rate which is already defined. So in this case, the answer is the bondholder has the right to force the issuer. See, investor when can go when investor has the right to ask the company to pay him to repay the amount he has invested right away. This is called putable. And when the company has the right to call the investor to make the payment, this is where they call it callable. Okay? Company has the right, then callable, and the person is asking for their right, he's putting it in on the desk. Na? These are putable. So that's the answer. Acha, what is the result if the bond is referred to as callable? The bond can be traded on stock exchange. It is for a fixed period. The issuer had the right to repay the bond before the maturity date or the bond is backed up. If we have done this question in a similar method, the answer is C, everyone. It has to be paid before the maturity date. Good evening, everyone. Welcome to Officer 24/7. My name is Niharika Valia Bhatnagar, and I am with you with the area of accounting and financial management. Okay, I hope I'm clearly audible as well as visible, everyone. Acha, what is it that I'm going to deal with today? As promised, we are continuing with our series. What is it about, everybody? We were talking about the particular topic of Module C, a very, very important topic, always asked in the examination. I don't think I've ever seen them missing this topic at all. The topic is foreign financial management. In terms of financial mathematics, we have the topic of forex arithmetic. Acha, what do you mean by forex arithmetic there? I'm having rupees. All of a sudden, at one particular time, I ask you that, sir, I want dollars. You're like, hold on, what is the price of the dollar today? And then I said, sir, I want to invest. I have to buy dollars for my rupees worth. Say I have got 85,000, convert this into dollars. What is the amount that would be converted? Because I have to send it to my brother. He's studying outside and I want to send it to him. I decided to tell you about this. And you were like, Acha, just a moment, ma'am. Let me just calculate. You will open up and you will try to find out what is the current price of the dollars in our country. And on that basis, I will be selling my rupee and purchasing the dollars. And then the dollars that I had purchased from you, I would be sending it to the concerned person. And a transmission is there. So this is the entire concept of forex, where the point is, how do we calculate how much rupees was converted into dollars, and what if it was into a certain currency which was not directly convertible within an Indian currency. For example, I had rupees, and then I said I want to convert it into yen, but there is no direct denomination available. Say, for example, that yen is not directly available. Matlab, first of all, I have to buy dollars, sell rupee, and then I'll have to sell dollars and I have to buy yen. That would be the point, everyone. What do? I have currently got, say, some certain amount of rupees. I have got rupees. The rupees would first of all be converted into dollars, and then it would be converted into the yen that I want. You know, so technically in this case, what's gonna happen? Then to convert, first of all, you will sell off rupee, you will get dollars. You will sell off dollars and you will get yen. That's the entire criteria for the forex. Then whatever arithmetic methods you are using to convert it is termed as forex arithmetic. They have current prices, they talk about the future prices of those particular things that we are investing our money in, and there are many other things where they are considering all these important elements. If you like this particular session, then please go ahead and share it among your peers and don't forget to like it as well. Uh, Covering from this topic, what kind of coverage they normally cover in the examination, the coverage is related more towards conceptual questions as well as numerical, both. There hasn't been a situation where they're just covering for the a portion of theoretical, but they are covering it from the numerical point of view as well. The numericals plus point of this topic is very chotu, very clear, very simple, and all we need to understand is all the conceptual areas of this particular topic. So let's continue and talk about the area of forex arithmetic, everyone. In this particular method, when the direct quote is not available, direct is where if I can directly take into this, that if the direct quotes are not available, then you have to do it using a chain rule. TK will be talking about the chain rule as well. Till then, let's begin with the session, everyone. When the exchange of the currencies takes place on the next working day, it is known as, what will it be called, everyone? What will it be called? When the exchange of the currencies takes place on the next working day, it is known as spot, TOM, cash, or ready. Spot is the current rate, the price that you can buy it right away. Tomorrow is if you decide to buy the particular units, not today, but tomorrow. Cash and ready are some terms which they have just stated. This is a question from the IIBF book itself. So, what's the correct answer? When the exchange of currencies takes place on the next morning, we're not doing it today. If we are talking about the transaction today itself, then it is spot. It is normally delivered within the period of next maximum T plus 2 days. Now they're reducing it to T plus 1 as well, but in the Macmillan book we have written as it as T plus 2, so going as per that only. The correct answer is I'm sorry, in this case the answer is B. Let me just correct this part for you. It is TOM, everyone. It is also called tomorrow. And everyone, chaliye. Now let's move on to the next question. The answer is TOM. Acha, what's the next question, everyone? When the exchange of currencies takes place on the second working day after the day of the deal, what is it called? Actually, no. What will it be called, everyone? When it is done by maximum second working day. Not talking about the first, but the second one. When you are finishing it off in maximum 2 working days, then what is it? We've talked about this earlier even. Spot, Tom, cash, ready. See, the transactions which are related to current situation, but it can be delivered in maximum 2 working days, then the answer is T plus 2 is spot. Okay? The delivery can be made within the next 2 working days. That is why it is called T plus 2. Then next question. Which one of the following statements is correct about forward rate? Acha, everyone, as I am sending something to my brother there. He's sitting outside India. He's sitting in, say, USA there. And I decided to send him dollars. But the point is, he doesn't need the dollars right now. He would need the dollars maybe 3 months later because I have to send him the fees. So I decided I'll send the dollars 3 months forward, but I don't want to risk about the fact that what would be the price after 3 months. Matlab currently, if the price is around 82 point something, it is expected that over the period of time it would go up to 84 rupees. 2 rupees, 2 per dollar is not a small thing if I'm sending good number of dollars there. It would create a huge difference while sending the money. I'm sorry. So I take a decision. I have a word with the particular person and I ask them that I would like to buy after 3 months at the same price, that is 82. I would like to have a constant price. Be it your loss or my loss, we will not change it. We will keep it at 82 rupees. This particular futuristic price that we're keeping for the dollars, it's called forward rate. This is not only for the dollars, everyone. This is for any kind of currency that we are having. Okay, that's how we define the term forward rate. In case of direct rates, if the forward rate is more than spot rate, if your forward rate is more than spot rate, the currency is at a premium. If the direct rates, if the forward rates is less than the spot, it is called discount. The forward premium or discount is expressed in terms of forward points. The points are related to the area of the premium or the discount. Matlab, if it is valued at a higher price or the lower price, the futuristic version. Obviously, there are certain things when it actually happens. I'm sorry. When it actually happens, only then you come to know whether it is actually a good thing or bad thing for you. For example, I'd seen people taking decisions and then later on reviewing, long term may this was good, or in the long term it was wrong. So that means the time that particular situation futuristic doesn't come, we don't know. In case of direct rates, if the forward rate is more than spot rate, if your forward rate is more than spot rate, the base currency is at a premium. Matlab, the future it is going to be more. Currently, it is at a lesser price. This is a situation where it will go at a premium, where your spot rate is, your forward rate is more than, acha, forward rate is less than, है ना? Forward rate is less than spot rate, then what will happen? Then it will be called it is at a discount. है ना? This is also true. That means at this point of time, the value is less. The if it is basically a situation where at this point of time we are sitting at 81, and in the near future it's going to be 80 rupees. So currently we are sitting at a higher price. Over the period of time it will decline, so we will call it the base currency is at a discount. The forward premium or the discount expressed in the basis points is called forward points. What is it called? These points where we have a good point in the future, the price is going to increase or price is going to decrease in future. It's called forward points. So all of the above is actually the answer. Done? Which one of the following factors determine the forward points? Supply and demand for the currency for the settlement date, market view, or that is expectations about the future, the interest rate differential between countries whose countries are being exchanged, or all of the above. Everybody, what's going to be the answer? In this case, they're saying the following points will determine the forward points. Matlab, whether the future price is going to increase or decrease. It is impacted by what? Supply and demand of the currency. Is it affected by the expectations of the future? Maybe in the future we see that there is a darkness coming in. So we will invest right now more and we will try to make speculative profits as well. Currently, you know, but when if what if I believe that in the upcoming future there is still going to be stability, then my pricing and my purchasing of these shares and all would be very different. The interest rate differential between the countries whose countries are being whose currencies are being exchanged. Matlab, what is the price rate difference in that particular country and ours? For example, if I talk about any other country where the value of their currency is less than ours, we can buy more of that currency, right? If I have 1 rupee, then I can buy more than $1.5 of the same. I can buy up to $2. It will vary, you know. So that is what it is about. The forward rate includes all these 3 points. The answer is all of the above. Here comes the next question. What is the direct quote for foreign exchange, everyone? What is the direct quote for the foreign exchange represents? Price of the currency in terms of another currency, price of the currency in its own currency, the rate by the central bank, or average rate in the global market. How do you define the term exchange? Direct quote. Direct quote is when you are given the price in terms of its own currency. Okay? The answer is price in of currency in terms of its own currency. $1 is equal to 82.84 rupees. This particular situation is called the direct quote, everyone. And what if they ask for indirect quote? How many dollars will you buy with 1 rupee? So it is going to be 1 rupee is equal to 1 divided by 82.84. This is conversion, everyone. Okay? In this case, this is the formula. Everyone, the direct quote is where your rupee is denominated in terms of the dollars there, and in the opposite case what's going to happen, the dollars in terms of 1 rupee, what would it be? Now what would be the answer, everyone? In this case, as we already know, the answer is B, the price of the currency in its own currency. Now next point, how is discount characterized in the terms of forward rates, everyone? cheaper future rates, costlier future exchange rates, or same as spot rate. And the last one is similar to the uh, fixed. Then this same as a spot rate, and the last one is fixed future exchange rate. So we have decided that if these are not to be taken, then what is the amount to be taken? Na? Forward rate is the rate that would be available in the future. If this is a futuristic vision, what amount would be kept? Definitely going to think that in the future, the exchange rate can be cheaper. That is why we will try to have it in future rather than present, and we determine the price in advance, that this is the fluctuation, that in the future if our value is going to be more, or if our value has to be less, we have to cover that part up now. If we do not, then what will happen? It will impact our working altogether, isn't it? So in this case, the correct answer comes out to be cheaper future exchange rate. Acha, how are forward rates generally expressed in foreign exchange? As a percentage of spot, as a discount only, as a premium or discount for the forward period, or as a fixed value unrelated to the spot? Everybody, what would be the answer? How will you define this? When we talk about the forward rates, now the forward rates can be positive. In the upcoming future, it might increase or it might decrease. You know, both the things can happen. So in this case, what would be the answer? It would be both. It can be given as a premium or as a discount, because the value of the same can increase in the future and can also decrease in the near future. We're not talking about anything else, but we are looking everything from the point of view of near future. And actually, this market cannot be predicted that easily, because the value or the prices of the currency keeps on changing. How is spot rate defined in exchange? Forex, everyone. How is the spot rate defined? Exchange on the same day as deal, exchange on the next working day after the deal, exchange on the second working day after deal, or exchange after the period of 1 week. Done. When we talk about the spot rate, everyone, spot is basically a situation where we are talking about this is basically settled within t plus 2 days maximum. Matlab the transaction day plus maximum 2 days afterward. That means in this case the answer is going to be exchange on the second working day after the deal, not before. Huh? It is after the completion of the deal, everyone. Next point is related to the area of. Acha, here comes a question. Huh? If the rates in the Mumbai market are US dollars, this is called buy and sell rate. This is buy, you buy low, sell high. If someone offered that buying rate of dollars as per rupees is given, and the selling rate is also available, then the rates in the London market, that means, achha, everyone, I was in Mumbai. I wanted a few euros. So the person actually went to value the same from Mumbai to US dollars, and from US dollars to euro. Technically, this is what is happening now. If the rate in the Mumbai market are US dollars 1 is equal to, if you buy US dollars, then it is 74.8450. If you sell, then this is 74.8545. These are the last three digits are going to be the same. It's going to be 74.8545. And the rates given in the London market are what? The rates in the London market are US dollars. 1 euro is equal to 0.9027. Now that means if I give away 0.902 $1, I will get not even one full euro. That means euro dollar is stronger. First of all, from Mumbai to US dollars, you're going to sell US dollars and then ultimately you will buy euro. है ना? This is what you're going to do na. You will have to sell dollars and buy euro. If this is what you're going to do, then these two, always remember everyone, when your LHS are same, when your LHS are same, in the first case it is 1 US dollars is equal to 74.8450, and the selling was done in terms of US dollars 1, and we have got it for $0.9027. So can I say in this case what's gonna happen is this particular person Berta, in this particular area what will happen in this area, we will just divide it. Sorry, in this area we will just divide it. How do we divide it, everyone? When LHS is same, this is the chain rule. Chain rule says if LHS are same. Can you see in this case both the points? This is in US dollars and this one is also in US dollars. This is euro and this is rupees. Then you will have to divide it. Why do you divide it? 74.845 divided by 0.9027. This will give you the answer. What is the answer in this case, everyone? What's your answer? This is actually the chain rule that I was talking about. Chaliye. Let's just calculate this portion. It is 74.8545 divided by 0.9027. It gives us 82.92. My answer is C. This is the chain rule, everyone. If your LHS currency is same, then divide. If LHS currency is not same, then multiply. Hello everyone, welcome to Officer 24/7. My name is Niharika Walia Bhatnagar. Now with the area of AFM. Okay everyone, if this session is helpful for you, then please go ahead and like it first of all and share it among your peers, because it is very important that we keep on sharing the most important information about all these important classes and the important topics that we have taken up among your peers who are also preparing for the same examination. Acha, we were talking about YTM in the previous class, which is also known as yield to maturity. That means the income that we need to have till the time we reach the portion of maturity. है ना? This is what we look forward to. So YTM is referred to that particular amount. So let's talk about it. What is the characteristic of fixed rate bonds? Variable coupon throughout the bond's life, coupon linked to a reference rate, or coupon that remains constant issued at a discount to par value. What would it be, everyone? Fixed rate bonds. The bonds which have been having what fixed, everyone? The bonds which have a defined rate, or this rate is also called coupon. So when we define coupon, the answer is going to be where the coupon remains the same. That is, the coupon remains constant. Constant means it remains the same. What is the feature for floating rates notes, everyone? FRNs are basically, okay, let's just talk about it and then I'll let you know about the answer as well. Fixed rate coupons or coupon linked to a reference rate issued at a discount or par value or pay no regular interest. Acha everyone, floating means, how do we define the term floating? Floating means that keeps on changing, है ना? Anything which does not remain constant is something that we can define as floating rate notes. And if you're defining the floating rate notes, it is basically coupon linked to a specific reference rate. And this keeps on varying. Done everyone? That's the answer for this question. Acha, how does a zero coupon bond differ from other bonds? See, there are two kinds of bonds. So there are different kinds of bonds, but let's talk about coupon rated bonds and if they say zero coupon rated bonds. Does this mean there is no interest? Obviously, this cannot happen. Why? Because if you give me 100 rupees and I give you back 100 rupees, what are you making out of it? Nothing. And if you're making nothing out of it, what's the benefit? I don't think then there is any benefit of doing that particular transaction anymore. To do a transaction, what would be the stronger reason? To do a specific transaction, the stronger reason would be that we are looking forward towards the portion of increasing our income. है ना? If we cannot receive any income, then it's just not worth it. Right, everyone? That is the basic thing that we'll think of. So technically, when we talk about this specific point, the basic things that we look forward to is any kind of income we are generating. Coupon rate means where there's an interest rate which is already defined, right? And if that interest rate is not already defined, what else will we do? When it is already not defined, the very next thing that we'll do is the company can issue two kinds of bonds. 12% bonds. That means the interest rate is 12%. Zero coupon means issued at a deep discount. Issued at a deep discount. Maybe issued at 87 rupees and given rupees 100. Technically, you are getting 13% here of your face value, everyone. So can we say zero coupon bonds have no regular interest payment, or these are issued at a premium to par value? No. Coupon linked to a reference rate? No. Do they pay regular interest? Zero coupon. It itself says that there is no interest. There is no regular interest payment. Acha. How are zero coupon bonds usually taxed? How are they taxed, everyone? How do you put tax on it? Taxed on a higher rate of interest than other bonds, taxed as a regular income, taxed as capital gains, or taxed as interest rate rolled up to maturity. Zero coupon bonds are everything. Acha everyone, whenever you sell or a particular thing reaches up to a maturity period, this is not only for bonds, this is for every investment. After a certain period of time, you will receive money. Okay? So when we receive this money, then this is normally when you either sell it before time or at the time of maturity when company makes a repayment. This is where you receive income which is subjected to tax. Done. So in this case, the correct answer is taxed as interest rolled up to maturity. Next point. Which type of bond is linked to the reference rate, such as alternate reference rate? Fixed rate bonds, zero coupon, floating, or secured. Let's talk about each and every bond as well. Now, fixed rate bonds has a specific rate of interest which is already defined, right? Then the next point is, if this is already determined, what's the next point that we need? Zero coupon is basically what? There is no interest, just a major discount, and that is the form of income that you're receiving. Floating rate notes are basically, there is a floating rate, the market rate, their reference rate, which it is related to because it changes the uh, rate that we are charging also changes. Secured bonds, when the bonds are related to some kind of security. है ना? So in this case, what's going to be the answer? The answer is floating rate bonds or floating rate notes. The other name of FRN is ARR. Okay, this is basically, oh, we talked about alternate reference rate. Now, this is the rate that they choose in terms of making the variations. Acha, next pointer. Uh, what characterizes high yield bonds, commonly known as junk bonds, rated above investment grade by credit rating agencies, issued by government entities, rated below the investment grade by credit rating agencies, have a lower yield than investment grade bonds. What would be the answer, everyone? Okay. What characterize the high yield bonds? Junk bonds are basically the ones which is basically related to the area of how do we define junk? Junk is basically the ones which can have a major amount of income, but there is too much of risk involved in it. So obviously people know that when they receive money, it would be a huge amount of money. But why would we try to put up a huge amount of what should I say, risk for it? You know, so basically these are risky bonds. But once they pay, they pay you good. But the risk is so much. Again, I'm using the term risk, risk, risk. So obviously, when you talk about these risky areas, they are rated below investment grade by credit agencies. That's the truth. Okay? They are rated below investment grade by the credit rating agencies. What distinguishes perpetual bonds or perps from other bonds? But the perpetual means which has endless life, a very long life, I would say. So in this case, these have what? Have a lower priority in case of liquidation, backed by cash flow for mortgages. There is no maturity date or pay no regular interest. Okay, when we talk about perps or perpetual bonds are specifically those kind of bonds which are related to the area of perpetual means till the time the company isn't dying, na, we are not paying it. They have a low priority on liquidation? No. Uh, these kind of organizations have been defined in a specific way that they have till the time the organization is alive. These bonds are not paid. These are called perps. So when we defined perps, how can we specify it? Perps have no maturity date. They have no specific maturity date. What is a characteristic of a bearer bonds, everyone? Bearer means, we have talked about the bearer in the previous class as well. Bearer bond means a bond which has no specific amount, no specific name specified. Okay? Registered by a number to prevent counterfeiting. Counterfeiting is basically to create a copy. Backed up by mortgages, secured ones, callable by the issuer. They're callable bonds issued without the named holder and can be claimed by the person with the paper certificate. So correct answer is bearer means which has no specific name. The answer is D. What is the term for bonds that have a low priority than other bonds of the issuer in the case of liquidation? When the company is dying, these bonds are like, acha, theek hai, we'll pay them, but not right now. We haven't decided whom we are paying and by what time we'll be paying. Convertible bonds, perpetual bonds, subordinated, or bearer. In case of liquidation, those are subordinated bonds. The bonds which are basically given a priority but after other bonds. So matlab it's a bond which would be paid off, but the others would be paid off first and then the payment would be made to this one. ठीक है जी. अच्छा, a practical question. A bond of face value 1000 uh, with a coupon rate of 12%, maturity for 6 years. मतलब the initial investment is of rupees 1000 जी. Then we have interest rate. How do we define interest, everyone? It is 120 for 6 long years. 1, 2, 3, 4, 5 and 6. This is 120 for 6 years and the YTM is 10%. Matlab, I can say this is 0.909, 0.826, 0.751, 0.621. Rest, I think I will have to calculate it for you because these are the ones which I remember by heart already. How do we calculate this amount, everyone? In case you do not know, what you can do is please open up your calculators and do as stated. First of all, you pick up this specific point that you have 10% YTM. So what you need to do is 1 divided by 1.10. How did we reach 1.10? This is 100 plus 10%. Sorry, 1 plus 10%. You just write 1 and plus 10%. That gives you 1.1. So 1 then divided by 1.1. First it will give you 0.909. Click on it again. It gives you 826. Click on it again. It gives you 751. Then it gives, sorry, 6, 8, 3. Then the next one is 6, 2, 1. And the last one is 0.564. Then either you multiply it individually or you total all these. You just have to do the total and then multiply it by 120. The total. Plus, in the last year, in the 6th year, you will not only receive this 120 rupees, you will also receive back the 1000 rupees that you have invested. So technically, it's going to be 1000 multiplied by 0.564. So what's going to be the answer in this case? The answer is going to be rupees 1000, everyone. Okay? So you have to add up all of these. 0.909 plus 0.826 plus 0.751 plus 0.683 plus 0.621 plus 0.564. 4.354. So technically in this case it's going to be 4.354. And when you multiply these individually, you will get the answer of 1000 rupees. Done? Acha. What option like features allow the issuer to repay the bond before the maturity date? Can we pay the bond before the maturity date, everyone? Yes, we can do that. Is it put option, call option, inflation indexation, or convertibility? It is call option, where the company, C for company, C for call. Company can repay the money to the investors as and when bank wants to do it. The investor, the company wants to do it, either if it wants to pay before time. Okay? And when you do this, you also get rebates as well. Right? Now, this is a portion where we talk about the bonds there. Now, when we talk about callable bonds, this is where the issuer of the bonds says that if I get the money before time, now I'll pay you before time. And normally, I don't think investor will have any problem because if the money matures, he can put it somewhere else. So he's all sorted ki theek hai na, if I'll be receiving the money, I can put it somewhere else as well. There is no hard and fast rule that I have to do this with my money or that with my money. Hai na? Okay. Oh. This question doesn't have the portion of solution. options there. So let's just discuss it. A bond whose par value is rupees 1000 bears a coupon rate of 12% and has a maturity of 3 years. So technically the interest rate is of 120 rupees, that is for 3 years. And after 3 years you will also receive back the rupees 1000 again. The coupon rate of interest is 10%. How do we look forward to it, everyone? First of all, the interest rate of 120 is for 3 years. है ना? So you do the PVIFA for 3 years. In the third year, the value comes out to be 0.751 even. Kindly refer the previous table which I had prepared where we talk about 0.909, 0.826, 0.751, all those things. Huh? So this is for the value for the third year, and this is where you will find the particular details of it as well. And the answer will come out to be 1049.44. Everyone, it started with 1000 rupees. Right now it has reached to 1049.44. Right? So this is the value of the bond. Chali, that's it for the day, everyone. I hope this particular session was beneficial for you. If it was, then please go ahead and like it. It was a precise session which was taken specifically keeping in mind the topic of YTM, which is a super duper important topic for the examination. है ना? So before I end my session, let's reach out to our website first. This is our website, www.adda247.com. Go on to our website, go on to the area of JIIB and CIIB. Then go on to the area of JIIB May 2024, where you will find the double validity is going on our Mahapack. Along with this, our resolution batch is also out. So you can take up the JIIB Mahapack 2.0 along with the area of resolution batch. Overall, JIIB Mahapack includes both bilingual and English medium batches, while if you take up only the English medium batch, you will not be able to access to the other courses which are there in bilingual. Okay. Then secondly, in both the areas you get ebooks, so both the areas you will get anything which everything which is related to this particular examination, everything would be available as per the examination itself. If you take up the double validity code right now, all you need to do is use the code Y541 and you will get the maximum discount. Apply it and you will get a discount of 6298.95. This is for 1 year. You just have to pay 6298.95. Right, so you can use this particular code and get yourself our Mahapack as early as possible. Please enroll yourself before time so that you can avail this offer.